Welcome to Idea to IPO. My name is Rob, organize Idea to IPO. We've been holding events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 2,417 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we're 100% online. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. Our featured speaker tonight is Roger Royce, one of the top startup and venture capital attorneys in Silicon Valley. And he is passionate about helping entrepreneurs succeed. Roger, take it away. Audio.
You think I'd know by now to unmute my audio, but at least you told me this time instead of waiting 20 minutes. Anyway, thanks for joining everyone tonight, for tuning in. It's about 7 o'clock here in California. I see we have people from all over the world. It's morning where you are, it's night where I am, and we're going to talk about how to prepare your startup for venture capital investment. Part 1. As you might have surmised, part 1 means that there will be a part 2, and that will be 2 weeks from today. Same time, same station. By the way, I'd like to, first of all, I'd like to thank Idea to IPO for inviting me to be here. I'd like to thank you for attending. I'd like to thank Kamala Harris and Vice President Pence for delaying their debate a day so that they could let everybody come and join our presentation here tonight. Now, before we get going, I'm going to launch a poll. You know, I like these better when I could hear people laugh because I know that you are laughing hilariously. Who's in the audience tonight? How many of you are entrepreneurs? How many of you are investors? How many are techies? Are you with an established company or are you with a startup? Any service providers like me? Any students? Any government people? While you're doing that, while you're taking that poll, want to let you know that if you want to chat with me, use the chat box, but only not for questions, not for substantive questions. Primarily, really the only thing I like to see in that is if you want to chit chat and tell me how good I look, or if you want to tell me that you can't see my slides or you can't hear me or something like that. That's a good thing for the chat box. I'll take a look at that from time to time. If you have a substantive question, you should type it into the Q&A box. I'm going to wait until the top of the hour, 8 o'clock California time, finish my presentation and go ahead and take your substantive questions. We have a big audience here tonight. I expect we'll have a lot of questions. All right, the results of the polling are in. 75% of you are entrepreneurs. Holy cow. We have a few techies, only one investor, and a couple of service providers. All right, how about that? Let's try another poll, because I'd also like to know where you folks are from, because we are doing this at 7 at night. I know a lot of people here in Silicon Valley don't like to stay up that late. Oh, well, look at there, you're proving me wrong already. Almost everybody, well, let's see, Silicon Valley, other North America. Are you from Western Europe? Are you from Eastern Europe? Are you from Asia? India, Africa, the South Pacific, Latin, and South America. I don't have an other this time, so I hope you can fit within one of those categories. Wow, nobody from Europe. That is amazing to me. Half the people are from Silicon Valley. A lot of people are from other parts of North America. Interesting. That's really interesting because that is going to inform what I talk about here tonight. Because I do want to give you something. Europe is sleeping. Oh, okay, thank you. Well, hell, they should get up to listen to this. Actually, you don't have to because this will be recorded, and if you wait a while, you'll be able to find it. Anyway, what I was going to say is that does inform what we're going to talk about tonight, because I want to make this relevant to the audience. And depending on where you're from, the content changes ever so slightly. Not very many people from Asia, only 3 folks out of everybody so far. About half the groups from Silicon Valley, about a third is from other North America, and then everyone else is from someplace else. Okay, that is the end of the polling with 91% voted. All right, now for the tricky part of the evening. I am going to share my screen. So if you don't see my slides in a minute here, chat me. Not yet, not yet. Oops, hold on, I messed that up. Okay, now you should see my screen. Now you should see my slides. Somebody chat me and tell me if you see a slide. We're going to talk about how to prepare your startup for venture capital investment. Part 1, idea to IPO. Okay, I am now on slide 2. This is the disclaimer. Even though I'm a lawyer, can't help it. I was born that way. It doesn't mean that I'm giving you legal advice. In fact, if I do this carefully enough, I won't give you any legal advice at all. I'll just give you good general advice. Legal advice is something that is very particularized to your situation. So take what I say as a generality that informs you for your general education. Okay, you should be looking at a slide that talks about why this is important. This is so important, why we're talking about venture capital when we're in the middle of a pandemic. And I've heard some people say there's a recession, depending who you talk to. Well, I will tell you why. It's because the VC market is still pretty hot, especially here in Silicon Valley where I am. But not just in Silicon Valley, but also globally. And I'm going to tell you why in a minute. But what we've seen is early, you ever remember 6 months ago, last spring, when we were all going to have to sit home for 2 weeks, maybe 2.5 at the outside? Well, the VC said, well, we'll take a little break. There's a little bit of a pause. That pause lasted about a quarter, maybe 2. But you'll notice that the number of deals then came back in second quarter of 2020. I don't have third quarter numbers yet. These are from the PwC Insights Money Tree report. But I can tell you anecdotally that Q3 was strong. There's a lot of VC money. And number of deals you can see was up. Number of deals was up in Q2 over Q1. Not as high as Q4 of 2019, but still pretty darn high. The financing pace is still a little down for this year, but halfway through the year, it was a little shy of 50% of last year, but we're still at high levels, record levels of venture capital. Year-to-date US funding, little less than the first half of 2019, a little less, 7%. But still pretty darn high considering what's going on out there. I think you'd have to agree. And here's what's probably most interesting to our typical idea to IPO audience, is that seed deals saw a rise in Q2, right? So seed stage deals are up. And I will tell you the reason that happened is I sat on enough venture capital panels to know that the VC community, especially at seed stage, we finished up the deals we were working on in March, but then people just sat back and waited for valuations to fall before they would go out and invest again. And people sat back far enough to where finally FOMO got the better of us all, better of them all, I should say, the VCs, and people started investing again, but definitely in seed stage deals. So that's why we're here. Venture is hot. There's still an opportunity for venture, and something I'll talk a little bit later is that for those of you, the 50% of you, 60% actually, that are not from Silicon Valley that are in the audience tonight, there has never been a better time for you to access Silicon Valley venture capital. I've talked to so many VCs now, probably all of them that I know that have funded companies, founders that they have never met in person. They only know them through platforms like this: Zoom, WebEx, GoToMeeting, Teams, Hangout, etc. So that's unprecedented. That would have happened a year ago. It's happening now. So think about that. That means it doesn't matter if you're across the street or if you're across the world. If a venture capitalist is willing to fund you without shaking your hand, you can be anywhere. So what should we talk about tonight? Well, we're talking about preparing for venture capital. So to prepare, I just pulled this graphic off the internet. I like it. I'd like to give it attribution. It came from Pinterest. But if you look way down at the bottom, if you can read that, I can't. There is attribution who it's from. But in any event, I like the idea here. This is idea to IPO in a graphic. Idea stage, we have a founder. The founder owns 100% of the company. It's pretty hard to screw anything up at that point. Co-founder stage is when things start getting interesting. We have founder number 2. Your valuation is still pretty low. It's pennies really. Family and friends come in. We're getting ready for venture capital. You're going to have to stage yourself to get there. Founder money comes in. Your uncle's money then comes in. You prove the concept. Your uncle doesn't need you to prove it. He loves you for who you are. Your angels, they do need you to prove what you're doing. You get to your seed round, or your pre-seed round, they sometimes call it. Beyond that, you get traction. Then you do your Series A, and now you're talking to VCs. We're not going to talk about the skyscraper at the end, the IPO, this week, but in part 2, we will talk about SPACs, we'll talk about Reg A+, we'll talk about IPO, talk about M&A exit. For now, we're going to talk about how to get to that venture funding round. So here's the run-up. Sources of funding. Where does that early money come from? What are the sources of funding? I mean, as you all know, I'm sure, you don't just get hatched and go out and see a VC, right? That turtle's got to make it to the ocean, from the egg, and then you got to make it out to sea, and then you got to make it all the way back before you can visit the VC. So how do you get going? So first of all, founder money. Every company has founder money. I shouldn't say everyone. I got a statistic later that'll tell you exactly how many do, but a lot of companies have founder money. Now, if you have questions for me, put them in the Q&A box. I'll get to them at the end of the presentation. So founder money, savings, IRAs. It's very tricky stuff, by the way, to use your IRA to invest in your company. That usually means somebody else's IRA. That's a prohibited transaction, and you're a disqualified person, so don't do that. Very tricky stuff to use an IRA. I'm not saying it can't be done. I'm just saying you have to avoid all of the tax rules. Credit cards, I hate to say, mortgage equity. I'm going to tell you that this is a fine line. If you're a founder, you need to put some of your own money in a company. You need to bet on it. You need to have skin in the game. You need to show people that you're serious. You need to get your feet wet. On the other hand, you don't need to do anything crazy, right? Like investing your IRA or mortgaging your house. I really would not wish you would not do that. I do know a lot of founders who who did all of this stuff, cashed out their 401ks, etc. That's, ideally you founder are only going to put as much money in this company as you can afford to lose, right? And you're only going to put as much money in this company as you need to get you to the point where you can take somebody else's money. Debt financing, good luck. Startups don't do well getting debt unless you're willing to guarantee that debt. Government grants, we're going to talk about that a little later. There is a lot of government money out there, and it's probably underutilized, although people are getting smarter. Maybe because you're all coming to my seminars or Rob's presentations and you're listening to me tell you, every other week you should look into government grants, because there is a lot of grant money if you're in the right industry. Friends and family, angels and seed investors in it, and then institutional. In part 2, we will, maybe even part 1, depending on how fast I talk, we will talk about alternative financing. Crowdfunding, is that a good thing? Is it a bad thing? Is it even a thing anymore? I don't know. Jobs Act, crowd financing, that's where you sell equity securities or debt securities. You sell securities in exchange for money. How does that affect your odds of getting venture capital? ICOs, that's an initial coin offering, STOs, security token offering, initial exchange offerings, and then royalty financing, which I'm hearing about more and more and more these days. Hearing about all this stuff more and more, actually, it feels like. Where does the money come from? Where does the money come from that gets these companies up to that venture capital stage? So here are top funding sources for a startup. This data is old, it's from Fundable, but it is still widely cited, even though I know it can't be right anymore, but it's good enough. It's good enough for government work, right? It's good enough to know that a lot of money comes from friends and family. And as much money comes from angel as comes from venture capital. I believe that's true. Anecdotally, that has been my experience as well. If you expand the definition of who's included in this group of startups, you'll find money coming from banks. Although with the PPP loans, that's a much bigger number now than it ever was any time in history. And crowdfunding, this slide's probably 10 years old. Since then, crowdfunding, especially the three main sites, have gotten so good. You know, I heard an ad for Our Crowd, Jonathan Medved's company, Our Crowd, on satellite radio the other day. That's how far they came. It's a crowdfunding site. They're advertising on international satellite radio. Crowdfunding is a mature industry now, and they're funding a lot of deals, really good deals. Here's a statistic, 77% of founders are going to use their personal savings or they're going to use their own money to get their company started. Just plan on doing that. If you're not willing to do that, you might want to go back to the drawing board. Debt financing. Like I say, good luck with debt. It is so rare that I see a startup use debt. You've got to be able to back up debt. I'm not talking about PPP loans. I'm going to talk about that later. But just general commercial debt. And plus, I just heard today that we're probably not going to have another federal stimulus program, at least not till after the election. So maybe we can stop talking about that for a minute and go back to fundamentals and basics. If you're going to do bank debt, plan on signing a personal guarantee, plan on putting up some security, some good security. It's not an easy thing to do. But I will put it out there because Fundable says that a lot of companies start off with debt. Has not been my experience, but they say it's true, so that's how you do it. Ta-da, here it is, free money from the government. Check out these sites, us.gov grants. There are some organizations out there that will help you with this process. There are plenty of consultants. It's worth taking a look at to see if you qualify for a grant. You know, it seems like every other company I see these days is a save the world company. They're doing something sustainable. They're I don't know, reducing fossil fuels or increasing food production, or they're doing something that the government might have an interest in. Education, health, you name it, food safety. Check out the government. You'd be surprised how much the government is interested in these days. Friends and family. 38% of startup founders raise money from their friends and family. Seems a little low to me, but okay. Average amount is pretty low. It's not very much. You're not going to, you know, because these people are taking humongous, tremendous risks. They're doing it even though your odds of succeeding are very small. So you're not going to ask them for more money than they can afford to lose. Please don't ask your friends and family for more money than they can afford to lose. You don't want to end up losing your friends and family. You can end up losing your startup. But and then finally, angels. Like I say, once you've got traction, and by the way, by traction, I mean revenue, I mean customers, paying customers. A lot of people, a lot of companies will go out there and get a bunch of free customers and say, look, we got customers. Okay, that's fine. That'll work on your friends and family. Will not work on angels. Will not work on angels. I just want to warn you about that now, or at least sophisticated angels. You ought to be smart enough to ask the question, you know, what kind of financials do you have, and is anybody willing to pay for this product at this point? or you've got eyeballs on your site, something like that, that shows that you're going to be able to scale. We'll talk about scale in a minute. Holy cow, it took me 20 minutes to say the word scale in a presentation of a venture. Angels, that's rich guys, or rich gals, rich people. Angel groups, that's groups of rich people. They get together, band of angels, Stanford angels, Harvard angels, all kinds of angels. They get together in groups. You go pitch to the group, they make a decision, and they jointly toss their chips into the pot. One step up is an angel fund. It's the same thing. It's a bunch of people that get together, but they pool their money, and you take one investment from one fund instead of 10 investments from 10 angels in an angel group. Now, you're going to need angel money before you go to venture. You know, every other startup I talk to doesn't believe that. Just like 20 years ago, they didn't believe they had to do anything to go IPO other than, you know, put up a little sign that says we're ready for our IPO now. I'm telling you, you're going to need that angel money before you can get to venture capital. Unless you're a rare company that, if you're the serial founder who's been tremendously successful before and you've got a relationship with a venture capitalist, okay, you got me. You might be able to finance that pitch deck. 20 years ago, kids coming out of college from a dorm room could finance a pitch deck with a venture capitalist. I did a lot of those deals. I had a lot of clients who's, I can't tell you, more than once. One time I had a banker called me up and said, are you a lawyer? And I said, yeah. And he said, well, you know, there's some kid down here, you know, in my bank, and he's trying to open an account. And he says, you're his lawyer. And I says, yeah, I know. He's for real. Started a company in his dorm room. If you're going to do angel financing, you know, take a look at this book. I don't know if you can see this or not. It's Angel by Jason Calacanis. It'll tell you how angels think. All right. It'll tell you how not to make any mistakes when you go talk to angels. It's also a pretty good book on how to prepare for venture and is generally how to structure your company. Do yourself a favor, you know, pick up that book. All right. So let's recap. You started your company. You got a founder. The name of the book is Angel, and it's Jason Calacanis. I'll post it here towards the end here. Put in some founder money. You've taken some money from your friends and family. Now you've gone to the angel, and maybe you've gotten a couple $100,000 from some angels. That was enough, and you had traction when you went to the angels, not a lot. Now you're ready. How much money should you have taken from the angel? I guess is my first question. I'm going to talk more about this in a minute, right? So we're going to think about that. I'm not going to answer that now. You know, I just want to give you the stages before we get there, right? But let's say you've taken enough money from the angel to get you to a venture round. For now, the answer is enough to get you to a venture round. I'll tell you more about what that means a little bit. All right, now you're ready. Put on your scuba gear. We're about to go swim with the sharks. We're about to go talk to venture capital. All right, this is the big leagues. This is, you know, men from the boys, that sort of thing. Question number one, you saw that big scary picture of the shark. It's pretty scary, so I took it down. I don't want to scare you. But the question is, should you even go there? Should you take venture capital? All right, so you need to do some soul searching. You need to ask yourself a few questions and come to terms with some very important realities. Number one, if you take venture capital, you have to give up equity. All right, well, duh, yeah, of course, that's what venture capital is. Why am I even mentioning it? Well, because equity is so much different than debt. If you're a company that's got revenue and you've got income and you can service debt, debt is way cheaper than equity, way cheaper, because when you pay the debt back, you're paying debt plus a little bit of interest. When you pay that venture capitalist back, you're paying them a piece of your company. You're paying them a piece of your future, a piece of the upside with preferences, right? So number one, can you take debt? Do you qualify for debt financing, right? Are you the kind of company that has enough cash flow that you can service debt and pay interest, right? Because if so, you might want to rethink this whole venture idea. Very few of my clients, I do technology startups in Silicon Valley, ever even think about debt. Most of them don't even know what that is, right? Except for their credit cards. They think about venture capital. because they're not a candidate for debt. They can't service debt. If they could service debt, they wouldn't be in the space that they're in. So they have no near-term cash flow. Secondly, venture is risky. Lenders do not like risk. You're not a candidate for debt if you're really risky. You are a candidate for venture if you are risky, but you have a commensurate high potential return, high reward, high risk, high risk, high reward. Okay, so maybe then you are a candidate for venture capital. Probably the most important thing, can your business scale? If you take that money, are you going to have that explosive growth that I keep hearing Gary Jenks talk about, right? Are you going to get so big, so fast, and get into the market before everybody else? And not only that, do you need to? Do you need to be the first one to the market, right? Do you have competitors? By the way, the answer is yes, you do. Even if you don't think you do, I promise you, you do. You have competitors. So you probably, if you're a technology startup in Silicon Valley, somebody else has thought of your problem. They might not have your technology to solve it. They might not have your exact business model, but they're working on that problem. So, and they're just as stealthy as you. They don't think you exist either. So, how important is it for you to get into that market and dominate and be the first mover before anybody else? A little redundant, I guess. Be the first mover before anybody else. And then finally, is it a huge market? Is it a big enough market that a VC is going to be interested? I'll talk more about this later. But those are the questions. Those are the questions you need to ask yourself. Now, let's say you answer yes. I am not a candidate for debt. This is a go big or go home opportunity where I'm either going to be a potential billionaire, or my company will be $1 billion company, or it'll be a big smoking hole in the ground. There's no in between. We're going to do big things. We're going to change the world. This is really risky, but if we pull it off, oh boy, that's us. And it'll happen, really quickly. Okay, you're a candidate for venture. Let's say that you are. Now you got to get inside the VC's head. Okay, so I'm going to help you to get inside the VC's head and let you know what they're thinking when you go talk to them. So let's start with something about, we'll call it venture capital economics. Start thinking what they're thinking when they come to see you. First time this ever dawned on me, it was probably 20 years ago. I was with my company, with my client. I was sitting there talking to a VC, and he was thinking really hard. It's like he is planning a chess move. I says, what is this guy? If I just asked him, I said, I just got to ask you, what are you thinking? What are you thinking about? And he's told me, he says, what I was thinking is that I got to get a 20% return before I even get anything, right? I was just thinking that I got to cover a carried interest, and I got to do that before my fund runs out. And I was just wondering if your company is going to get me there or not. Just light bulb. That's right. You got to get inside their head. What are they thinking? They're thinking that they got to cover a management fee, 2% a year for a 10-year life. That's a lot of money. It's 20%. I'm not good at math, but that's what it works out to. 20% carried interest. That's how much they get. The carried interest is the profit that the VC gets. And then the LPs, they get the 80% after that. Okay? So if you think about that, that means that they have to make a lot of money. They got to pay themselves 20% of the profits, then return, the rest to the LPs. So they're thinking they got to cover enough, to repay their LPs and then pay them. And the LPs are pretty demanding. If you do the math, you'll figure it out. To get the 30% annualized return that they want from a successful fund, they're going to have to get 2.5 to 3 times an investment return. That's what they're hoping for when they invest in a VC. So your VC is going to have to earn 3 or 4 times their investment to return that amount. LPS means limited partners. Sorry, thank you. That's a good question for chat, by the way. Thank you for it. That is an excellent chat question. I'm going to take a screenshot. I'm going to use you as a good example. That's how much they need to return, 3 or 4 times their investment. And I know what you're thinking. You're thinking, well, I think, yeah, we'll do 3 or 4 times your investment, but that's not good enough. Why is that not good enough? Because half of the investments that the VC invests in are going to lose money. Just statistically, half are going to lose money. 20 to 30% are going to return their money, or they're going to get doubles. And the rest have to be home runs. And nobody knows who's going to do this. I know you think you do, the VCs think they do. You're probably wondering, how is it possible that professional investors can lose money on half their investments? Well, because it's high risk, high reward. So just this week, 4 years ago, started a company. It was an agriculture technology company. It's one of my favorite verticals. They were in a great space. They got a great technology. They got an angel who is just a superstar, well-known name in this valley and on this planet to back them, because he really believed in them. Based on the reputation of that angel, they managed to get Series A and then Series B from the very top tier, most top tier Sand Hill Road venture capital funds, 2 rounds, top tier VCs, name brand angel behind them, and they just closed their doors this week. Went out of business. Took them 4 years. Spent every dime, could not turn a profit, could not raise another round, even in this hot market that we're in, closed their doors. The VCs all lost money in that deal. Best VCs in the valley, they lost money on it. Best angel in the valley, they all lost money. You just don't know. You just don't know. You have to expect that. So if you have enough of those, you understand they have to have some home runs. Now let's just turn this around on its head. This is an example that Scott Kapur, can't pronounce his name, uses in his book, Secrets of Sand Hill Road, which is another great book you should read, by the way, Secrets of Sand Hill Road. He says, look, he says, suppose our fund, those numbers look, I can't tell you what company it is. Those numbers all look, that's interesting, but the VC is expecting big returns, right? They're expecting huge returns. So let's do the math. Let's suppose our venture capital fund, they invest in your company and you convince them that you have the potential of having 100 times their investment. So they put $10 million in your company and they get 100 times their money back. How much does that VC have to make on its other investments now? Okay. Or what happens if, what's the return they need on the other investments in order to satisfy their LPs? And the answer, according to Scott, is it doesn't matter. That one investment made their fund. Now, as ridiculous as that sounds, that's what everybody is hoping for. A lot of funds do that. Some of the biggest companies in this valley have made their venture capitalists rich on that basis. That is what they're looking for. That's what they're hoping for. That's what they're expecting. That's what you have to convince them, that you are that company that can be a home run, 10x to 100x. Well, what kind of company is going to do that, you might ask me, and that's good because I'm going to tell you. Number one, you have to have not a large potential market, a humongous potential market. Notice I said potential market. That market doesn't even have to exist at the time you formed a company. Did the Uber market exist? I don't know. Maybe. Did the Facebook market exist? Certainly, maybe it did. But think about it. Those companies, in a way, sort of built the market, right? So it was a large potential market, not necessarily a large market. And we're going to see a lot more large potential markets developing. The world is changing so fast. And the really good angels are the ones that can get out their crystal ball and can see that market, but they can't see too far ahead. You can be too smart in this business. That's why I'm seeing a lot of companies now getting into businesses that are getting funded and are getting revenue and are actually getting consumer traction. They're fitting the market. That I saw that exact same company 10 years ago and they couldn't go anywhere. They fell on their butts and now they're doing well. Well, the founders 10 years ago, they saw too far ahead, right? They saw too far ahead. So it's a large potential market, right, that you can sell. Here's another good fit factor. Is there a first to market advantage? Remember what I said, venture funding is expensive. You take it because you need it. You take it because it's risky capital. You need it because you need to be the first one in the market. You need to take the market. You need to be the first mover, and then you're most likely to be the winner. So if you can show your VC that this is a humongous market, I figured this out. A few other people did, but they're all losers, not like me. Give me your money, and I'm going to get into the market before those guys do, and we're going to take the space. Long-term scale, right? You don't want short-term profits. You do not want short-term profits. VCs hate profits. Sounds weird, but I'm telling you, I've sat in those board meetings. I've heard them say, no, 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 we don't want profit. We have to pay tax on profits. What are you, stupid? We want users. We want long-term growth. We want to build goodwill so I can get capital gains treatment when I sell my stock in this company. So lower the price, do a freemium model, build up the user base. It's a very common, well-known strategy. I don't have to tell you about it. So you got to be the kind of company that can build that long-term scale. All right. Not able to service debt. We talked about that. And then traction. So let's talk a little bit about traction, because that is a really, it's a word everybody uses. Every VC uses that. Even the angels use that now. But it's kind of fuzzy. All right. It's kind of fuzzy. So to me, what traction means is synonymous with goodwill, with just the expectation that customers, and also here described as product market fit. It's the idea that you're going to be able to build your company and scale, right? So I like to think of it as just the idea that customers are going to come and use your product, right? That they're going to buy your product. The very best indicator, of course, is actual revenue. If people are paying for your product, if somebody bought one, well, hell, I think you can sell 10. And if you can sell 10, I think you can sell 100. Pretty soon you're well on your way to scaling. So it's got to be something like that. I mean, the best and clearest indicator, of course, is revenue. Another indicator is users, of course. Kind of depends on the company, but just keep that in mind. Again, get inside the VC's head. He's thinking, what is it going to take to make this company from a little bitty company to a great big humongous company that's going to make us all rich? All right. Couple more slides on venture capital economics. Just keep in mind that you're pretty darn important to the venture capitalists. So just, get used to being married to them. They're going to participate in your management. They're going to take a board seat. I promise you at least 1 out of 3 in your A round. They're going to want observer seats. If they don't get them, they're going to want what they call a management rights letter. This is a legal thing. We don't have to get into it now. It basically gives the venture capital fund the right to management, because that's what proves what they call a venture capital strategy. Their fund is going to last 7 to 10 years typically, and longer. I mean, I've got several of them we're extending now, because I don't know why, we just are. But think of 7 to 10 year term. So they're expecting to exit in that time. And if you don't, they might be quite insistent about this. I can tell you lots of war stories. I'll tell you only one. I had one company that in year, I think year 8 of the venture capitalist fund's life, we acquired a company for $40 million. Year 9 of the fund's 10-year life, they said, wait a minute, we got to exit. We only got a year to go. And they went, and they controlled the board, and they said, time to sell. And we sold that same company for $30 million. Go figure. Founders are not happy. And by the way, that brings up a really good point. First negotiation point, number one. Negotiation point number one. When you go to talk to the VCs, find out where they are in their life, right? Ask them where they are. How much more term do they have left? You don't want to, you may not want to get in at the end of the fund life. If you do, you want to know there's a fund 2 sitting behind it or in the works, or likely that's going to be able to pick up your next round and keep you alive. You'd like to be in at the early stage of the fund a lot of times, because that gives you a little bit longer runway to exit, so you won't get forced into a bad exit. Just something to think about and something to ask. You at least ought to know. But on the economics part, the point I want to make with this slide is that because VCs have to participate in management, they need to make bigger bets. They need to make bets that are going to move the needle. Now, there's lots of exceptions and strategies around this. We're seeing big funds, make $200,000 investments so they can participate in a later big round, right? But as a practical matter, they're in for big bets that can create big returns, that can justify their time. there was a time when I sat down and did the math and sketched it all out and figured out, the funds that I was working with, just how many companies they could invest in and how much they could invest. And, just because, how many boards could their team sit on, that sort of thing. That's a lot of work. For you, all you really need to know is that they need to make big investments so they can take a board seat and they don't have to go to so many board meetings. All right. So something to keep in mind. You don't go to a VC unless you want a big investment, or a small investment that will later turn into a big investment if you get any traction. So now, what's the VC going to think about when they look at you? We talked about traction. The other thing to keep in mind is, and I've heard this since day one, that venture capital is a people business and they're betting on a team. Remember what I said about how you got competitors even though you don't think you do? The way you should think about this when you go to talk to the VC is that somebody else is doing this. And if the VC is talking to me, they're probably talking to that somebody else too. And they're probably sizing me up against that other team that thinks they're going to solve the same problem. Well, what is it that's going to make them pick me, right? They've already decided this is a problem we're solving, or we wouldn't have the meeting. They're going to bet on somebody. Why me and not the other horse? Well, two things. Number one, the big thing is, are you the best possible team for that particular problem? Are you the best team that they can find for that particular problem? You need to convince them that you are. Convince them by having domain expertise. Okay, I do a lot of work with agriculture technology companies. I think I told you that. I'm from farm country. I've had to laugh out loud in some board meetings at the way that some people think agriculture works, especially venture capitalists. Trust me, you want to know your business. If you're doing fintech, you want somebody on your team, and they could be an advisor. You want someone that knows how finance works. If you're doing health tech, you want someone who understands that vertical. Domain expertise is really important. It's very embarrassing to get into that second board meeting and then come to find out that you've created a product that nobody is ever going to want, and you've solved a problem that nobody has. Technical co-founders, I'm kind of softening up on this in my old age, but I've heard enough investors say they want to see a technical co-founder on the grounds that it's hard to hire people to give you the kind of effort that you need. Like I say, I think that depends on the company, but it is one that can be very important depending on the kind of company that you have. Technology product, you want aspirin, not vitamin pills. Who said that? If you know who said that, send that to me in my chat. I forget who it was. Somebody, Andreessen, that's who said it, Mark Andreessen. You want to sell aspirin, not vitamin pills. Address a pain point, must have, not a nice to have. I had a sinus headache last week, and I'll tell you what, I would have paid anything for an Advil. You couldn't have given me a vitamin pill. Customer validation, you want to know the customers are going to buy the product. I'll tell you lots of stories about products that nobody cared about, nobody bought. And we already talked about market size. Has to be huge. All right, I want to talk to you about picking a VC. And I'm glad that we don't have that many of them on the line here because I'm about to say terrible things about them. Number one, check their reputation. If you don't remember anything I told you here tonight, remember this tip. Reputation is everything, right? And check their reputation. Unfortunately, VCs can have a bad reputation and live to fight another day. And they will tell you that you cannot. They'll tell you you'll never work in this town again if you don't play nice. But venture capitalists, we need to make sure that they play nice too. So how do you make sure? Number one, talk to companies they've invested in. Do your diligence. They're diligencing you. You should diligence them. You should talk to companies they've invested in. How are these guys to get along with? Okay. But even more importantly than that, I do this with everybody I do business with. Everybody I do business with, you're going to Google search them. You're going to check their LinkedIn, right? I know one venture capitalist, he goes and he friends them on Facebook and makes sure he doesn't see them with a drink in their hand every picture. Whatever it is, do the social media, but also check the court records, okay? You do not want to do business, not just a VC, anybody. You do not want to do business with a litigious party. You just don't. And yes, I know it's not their fault. There they were minding their own business when this founder came along, waving his arms like a crazy person. They had to sue him again and again and again and again and again. You know, they just made a series of bad choices. It's not me, it's you, right? Well, just check their litigation history. You don't want to, litigation, that'll wipe you out for years, all right? How likely is it that they're going to close? Find out. Do they actually close on their term sheets? Do they give out term sheets all over town and then walk away from it? I had a deal recently, won't say who, but this VC had us negotiate for 2 months, heavily negotiate, early, late at night, you know, argued over every stupid comma in every document. And on the day we're supposed to fund, we're sitting there waiting for the wire, and I get an email, changed our mind, decided we're not going to fund. How likely are they going to close? They give you a term sheet. Some VCs, the good VCs in this valley, if you get a term sheet, you can take that to the bank. They're going to close. That's who you want. What stage of the fund are they right for you? We talked about that size. Are they early? Are they late? Size of the fund, how big are they? Why is that important? Because you want to know how much dry powder they have. What's dry powder? It means that they can make follow-on investments if we need it. Is there a fund 2? Is there a fund 3? If there's a fund 2, there may be a fund 3. Are they young enough that they're going to be younger than me, so that they have an opportunity for a fund 2, a fund 3? And we talked about are they litigious. All right, structuring for venture. You know, we haven't even gotten into any of the technical stuff yet, but that's okay, because this is fun to talk about. Structuring for venture capital. Well, first of all, think of your business model. We'll talk about that in a minute. We'll talk about what kind of entity you want to be. We'll talk about what your cap table should look like and what it should not look like. We'll talk a little bit about vesting, and then a little bit about debt. So first of all, business model. Those of you who have seen me before, you've heard me talk about this over and over. This diagram just illustrates that VCs like risk. VCs like risk more than they like safety, because they like the higher return, okay? This is a diagram that was put together many years ago. I had a client, they came up with a really cool clean tech. That's how long ago it was. You remember clean tech? Clean tech is now a dirty word. They had a good clean tech technology, and it was so good that everybody in the world was going to want to license it and build. And we put that into a company, and we marched it up and down Sand Hill Road, and we got nothing but a series of no's. Got kicked out of every office in town. We had one, and I won't say which fund, but one of the big ones. The guy gave us 10 minutes, and he just stood up and he walked out. He just walked out. I mean, it was like the most humiliating thing, you know, just, you know. So we went back to the drawing board. We finally got some good intelligence that said, you know, if you were to manufacture that super duper product of yours, instead of just try to license the technology, the VCs might be more interested. So they pivoted. Remember that word, pivot, right? They changed their direction, and it became a manufacturing company. Exact same team, exact same technology, exact same company, exact same lawyer, exact same name. Everything was the same, except in their business plan, they changed it from, we're not going to license, we're going to manufacture. We got funded by 2 top-tier VCs. We took $11 million, and we closed it like that. That company has done several rounds since then, hasn't exited yet, but it's doing very well. So what I'm trying to illustrate here is, think about the business model that a venture capitalist is going to be interested in. High return, high return. They don't want to be giving up the return by paying royalties to somebody. They hate that. Okay, now we're going to get into some, it's an occupational hazard. It's a personality defect. I am a lawyer. I'm going to have to talk about some legal stuff at a high level. I have an article coming out in the Silicon Valley Business Journal this week called Choice of Entity. I highly recommend that you read it. It's going to be brilliant. We'll probably turn it into a movie, and we're going to talk about what kind of company you should be. You've really got, okay, we'll say 4 choices. Limited liability company, S corporation, C corporation. I'm going to tell you what all these mean in a minute, or foreign corporation. let me tell you what you want to be. If you're going out for venture capital funding, that's a tough choice. And the answer is, if you know, chat me. Okay, you lose. It is C corporation. Venture capitalists invest in C corporations. What is a C corporation? That's right, a Delaware C corporation. Paying attention. A C corporation is just a state law corporation that has not elected to be taxed as anything other than a corporation under subchapter C of the Internal Revenue Code. It means it pays tax on its earnings as a separate juridical and separate tax-paying entity. Why do VCs love C corporations? Why should you love C corporations? I'm not going to go through all of these 12 top criteria. I'm just going to focus on a couple of the big ones. Number one big one is something that everybody should learn and know. It's qualified small business stock. This is this incredibly investor favorable rule that I can't believe is still in the tax code. By the way, Joe Biden came out with his tax plan. I've been studying it for the last few weeks. He's going to raise taxes on everybody if he gets elected. I'm not saying he will, not saying he won't, but if he does, he wants to raise taxes. He wants to broaden the base. What that means is he's going to skim deductions. But he does not want to take away this benefit, right? This benefit survives. Republican, Democrat, conservative, liberal, 1202, qualified small business stock. And what it is the opportunity for an investor to exclude the gain from the sale of qualified business stock from federal taxable income. You still got to pay California taxes on it because, well, you know, we're in California. But for federal purposes, you can exclude up to $10 million or 10 times your basis, that's your cost, from federal income tax. It's amazing, it's incredible. It's a huge giveaway and investors love this. So this is one of the reasons companies want to be C corporations. That's more for investors than anything else. There's a lot of requirements. We got 8 minutes left, so I'm not going to tell you what they are. For your purposes, you just need to know that it's C Corp. Number two, VC's organizational documents, for a lot of technical reasons I won't go into, but I do fund formation, by the way, so I know this area extremely well. And when I draft fund formation documents, we would never let a fund invest in anything other than a C corporation for a lot of reasons. So the VCs can only invest in C Corps, and plus your angels and individuals are going to want you to be a C Corp for tax purposes. Moving right along, I want to talk about founders' equity. Okay, we figured out what kind of company you should be. Now, how are we going to split up the equity? You got your three founders in this case. They're all middle-aged white guys. This is not a very diverse slide. I apologize for that. I'll work on that for next time. But it still illustrates the point that even though these three guys look alike, they're not created equally. So typically, we would divide up equity equally. That's just generally how companies usually do it. It's probably the worst way to do it. The second way of doing it is to negotiate a split. That's a little better, but it favors the better negotiators. So that means if you're not good at pounding your shoe on the table, you might not do well. Thirdly, we do it by formula. We say, look, I'm working full-time, you're working half-time. I get, twice as much as you. Let's do the math. And then finally, there's something called dynamic split, which I can talk about, but that's the idea that you have a formula that moves and fluctuates. Look up the website slicingpie.com if you want to know about dynamic split. There are other methods, but that's as good as any. Next issue, now that we've split up the equity and we've decided how much the founders are going to get, and by the way, I'll help you with that, okay? I'll help you with that if you have that question. But those are just some of the ways that you would do this. Next question, vesting, okay? What is vesting? Vesting is the idea that people are going to lose their shares if they leave the company before a certain period of time expires. The idea that founders are going to earn into their shares. Okay, here's another question. Get ready to chat me the answer. Which founders should vest? The answer is all of them. They should all vest. They should all vest into their shares because you can't afford to lose any of them. How long should they vest? Typically, it's 3 years. Sometimes you see 4, once in a while you see 5. I like to start with 3. There's a lot of psychology behind that. given that I'm only on slide 29, I won't get into it. Say 3, sometimes 4 with a cliff. You know what a cliff is? That means you don't get any vesting for the first year. So if you, the founder, if you quit during the first year of the company, you got to give all your shares back, right? If you stay there 1 year and then you quit or are fired, you get to keep, 1 year's worth of vesting. If you have 4-year vesting, that's going to be 1/4, okay? And then you vest monthly or quarterly after that. That is vesting. That's your founders. Well, who else do we need to bake this cake, right? Who else? We got founders, got your 3 founders. Those guys look pretty smart. Got a financial guy, got a technical guy, got a business guy. We're off and running, but that's not enough. Who else do we need? Advisors. All right. We got a good student in the class today. You must have seen this before. Yeah, advisors. Those are people that fill in those gaps in knowledge or expertise that you, the founding team, don't have, right? You want an advisor to get you into the investment community. You want an advisor maybe to get you into the market. Remember I talked about domain expertise? You got an ag tech company, you want to have a farmer on your advisory board to tell you how it is you're going to sell your product to other farmers. Stuff like that. You want advisors. Those are advisors. Almost every company should have these because you can't know it all. And they deliver a lot of value if you find the right advisor. How do you pay an advisor? You pay him in equity, usually stock options. And here's a lesson that we all learn the hard way. You should pay them based on milestones and deliverables. Because how do you know if you got a good advisor? How do you know if they're delivering? Well, if your advisor's there because you need someone to get you 6 customers, then they vest as they get you those 6 customers over a time period. And the time period is usually 2 years. Now, some people would be purely time-based vesting, and that's okay for some people. But for the most part, you want to have milestones and deliverables so you know that they're performing. They're not like employees who just show up to work every day. How much do you give advisors? Take a look at the FAST model. You can find it online. Adele Rossi, a friend of mine who runs Founders Institute, created this. And he has a grid on the back of it. It's been downloaded tens of thousands of times. And it will give you a really good way to figure out how much to give an advisor. I like to just start at 1/4% and go up or down from there. But it depends on the advisor. I've seen advisors take 4% because they were celebrities. I've seen advisors take 1/8 or 0.1%. Someone gave me 0.1% once as an advisor. I felt a little offended by that, but I guess it's better than a poke in the eye with a sharp stick. What kind of currency do you give the advisor? You don't give them cash. That's right. You give them equity. What does equity mean? Almost always for an advisor, it means options. Doesn't usually mean stock. That's what founders get. Doesn't mean RSUs. We just don't use those. Those are restricted stock units. Usually means stock options. A stock option is a right to purchase stock. This value was built on equity compensation. It was built on stock options. That's usually what you do. But I know what you're saying. Well, gee, I don't have a stock option plan. How am I going to bridge that gap? And then I tell you, you got to get a professional valuation as a legal matter in order to put that stock option plan in place. And you don't want to spend $2,000 to $5,000 on a valuation. Plus, you're so early, how can they value you anyway? You're just a PowerPoint. You're just a pitch deck and some safes. So what we do is we put in place an offer letter that says we are going to give you, Mr. Advisor, an option for X number of shares as soon as we get a stock option plan, which should happen any day now, which will happen when we get financed. That's how you bridge that gap. Okay, I'm going to leave you with one last thing about this. This is actually a good stopping point before we get on to some of the meatier stuff, is vesting. Who should vest? Answer is everybody, every service provider. How long? Usually it's 3 years, could be 4 for founders, 4 to 5 years for rank and file, that's everybody else, 2 years for advisors. Why? Because the advisor had better have done his job within 2 years, and you won't need them anymore, right? So usually 2 years. And acceleration, I think I'll wait and I'll talk about acceleration the next time we come back, but that's the idea that people get additional vesting if you end up selling the company early, or if you fire them for no good reason, or you gang up on them because there's 3 founders and 2 of them gang up on one and kick them out right before they vest it, you might negotiate that they get some additional vesting in that scenario. I'm going to tell you what the VCs think about that in 2 weeks. But for now, we've got tons of questions and we're at the top of the hour. So I am going to go ahead and turn it over to questions. Okay, let me stop screen sharing. All righty then. Question. Here's a good question. How do I negotiate with potential investors? That's pretty broad, but actually, in fact, I think I've probably got a whole slide deck on negotiation. I know I've written on it, but it's a good question. So where to begin? How do you negotiate with potential investors? Well, in 2 weeks, we're going to go through a term sheet. We're going to go through what is as close to a mock negotiation as we can get to. And that term sheet is going to show you the kind of the standard terms, where the outliers are, where they're going to push back on you, what items are negotiable, what items are just don't bother, don't waste your time fighting over them, what are just standard market, and there's really just a handful of things. By the way, another book for you, Venture Deals. First one was about angel deals. This one's about venture deals. I like it. I don't agree with everything in it, but I agree with enough in it, and I'm going to wave it at you. Brad Feld and Jason Mendelson. And they will tell you there's really only 2 things to negotiate about, and that's valuation and control, right? Valuation and management. Those are the 2 things. And even valuation is more about economics. So we'll call it economics and control. How does money go in? How does it come out? So what we'll talk about in 2 weeks is what the universe of options is and how to compare them. Because ideally, you're going to stage this where, you know, you're the pretty girl at the prom and you've got a lot of suitors and you've got more than one investor giving you a term sheet, right? And you're going to need to be able to compare them. And I go through this all the time. And it's really, it's stressful, actually, if you don't know what you're doing. But if you do know what you're doing, it's pretty easy to compare term sheets, right? It's pretty easy to compare term sheets. So part of your negotiation is going to be able to know what points are important, what are red herrings, what points are not. Okay, next, and by the way, if you have a question, put it in the Q&A, don't put it in the chat. It's just a lot easier for me to read if it's in the Q&A box. Plus, I can keep them in order and I can stay organized, and I like to be organized. Okay, is an MOU sufficient to show traction, or does it have to be paying customers? Well, let me give you a very lawyerly answer. That depends. I think it's really good. I think if you got an MOU, that's awesome, but it's not as good as a customer. And the thing about MOUs is that they're generally non-binding and people can walk away. On the other hand, and by the way, I just had this happen. If that MOU is from Google or somebody, you know, if you've got that kind of vote of confidence. In fact, I invested in a company because I had an MOU from somebody like that about 3 weeks ago. That was the thing that kind of turned a corner for me. If you're getting that sort of attention, so I think it depends on the MOU, and it depends on the company, and it depends what it's going to take for you to execute on that MOU. How likely is it you're going to turn that into a paying customer? If I think it's likely, I think it's great, because it means that there's an opportunity there for me to have an unfair competitive advantage, because I can get in before you turn it into a customer, and the less well-informed investors realize what a great deal you are. Is the reputation of the firm more important than the individuals working for the firm, or maybe both? This is where I was talking about the reputation of the venture capital firm. Well, I'm going to have to say both, because you know, you're known by the company that you keep. There's a tone at the top. People get, you know, the friends they deserve, you know, all of that stuff. I think if a firm has a reputation, you're going to have to kind of count on people within that firm to act consistently. And that has been my experience, because it's not up. By the way, we'll talk more about this next week, but this has more to do with how VCs work. You're going to talk to different levels of VCs. You know, not everyone's a partner. Partners can make decisions. Okay, so the reputation of the partner is certainly a lot more important than the reputation of the associate, right? Or somebody, or the intern, or whoever it is that you've been talking to, or the manager. If you're talking to a decision maker, yeah, their reputation is super important. And probably more important than the reputation of the VC firm itself. But even they have to go back to their partners and get approval for a lot of things. What do I mean by that, by the way? Why do I keep talking about that? Why is reputation so important? What are these guys going to do to me, right? Here's why. You're going to get to a point where there's going to be an opportunity to double down or exit, right? To do another round or to exit. And it may not be the greatest thing for you and the rest of the fund to exit that early. Well, what does this firm do? What does this VC firm do? I mean, do they cut and run a lot, or do they stay in for the long haul? You know, do they support their founders? There's going to get to a point where you're going to get replaced. Promise you. You know, if you're a founder, you're a CEO, you're going to get replaced at some point. I'm not sure which round it's going to be, but it's going to be one of them. Unless you're Zuckerberg or Bill Gates, you know, or somebody who's super extraordinary and can go from idea to IPO as a founder and a CEO, you're probably going to get replaced. Well, are you going to have a nice soft landing, or are you going to get shoved off? Are you going to walk the plank, right? I'm going to push you over the side of the boat, right? VC firms have reputations that way. They have reputations as to how they deal with their founders and whether they're fair about it or not, and whether you're going to get any sort of parachute or whether you're not going to. But here's an even bigger one. What's going to happen when you need another round? Is this the kind of fund that's going to come back and they're going to starve you to death, wait until you're out of money, and then do an inside round and not even talk to the outside investors? You think that doesn't happen? Au contraire, I've seen it happen many times. You can then the VC double their stake at a too low valuation. Is this the kind of VC that does that stuff, or are they really in there with it? You know, or are they concerned about their reputation, so they're not going to do that kind of thing? They're going to stay with you. They're going to support you. They're going to want you to do an up round with outside investors as your next round. They're not trying to steal your company. I mean, I could go on and on and on and on. I mean, I've seen so many dirty tricks that I can't just go Google it, read the papers. Look, I'm not, I almost had a deal just now, even though it's in the paper, so I'm not going to. But, you know, just Google it, and you just want people that work and play well with others. I'm in agri-food technology. Awesome. Love that space. What is the current state of this space? Well, it's all about food safety these days. Check out our, in fact, before I leave, I'll chat you. Check out our ag tech programs. Idea to IPO has many ag tech panels and programs that we've done. And lately, since COVID, there's a lot of emphasis on consumerism, on direct to consumer. Supply chain is just a mess. So we saw a lot of problems and a lot of new solutions that came out of that. CPG has gotten, consumer packaged goods has gotten a lot of attention lately, but really kind of interesting is safety, food safety, you know, because everyone's worried about contamination in their food and stuff like that. So that's on the foods, your ag food, not ag tech. So that's on the food side. On the technology side, it's about robotics, data, autonomous vehicles, autonomous tractors, etc. But the current state of the space is there's probably never been a better time. There's just a lot going on in food. By the way, on that, not to spend too much time on it, but look what happened to the restaurant industry. I was an investor in a couple of restaurants, and look what happened to the restaurant industry. Well, the smart ones pivoted and figured out a way to do delivery, or they figured out a way to actually stay in business, or they figured out a way to have an online platform. The smart ones were able to turn that problem into an opportunity. So there are opportunities in food tech. Okay, we're a Canadian corporation looking to set up a U.S. I think you mean a U.S. corporation. Should we be in Delaware or Nevada? Oh, Nevada. Let me tell you my Nevada story. 10 years ago, I was on my way home from work. I stopped out at the Rosewood Lounge where all the billionaires who live in the mansions that line Skyline Boulevard. That's where they all live. They all claim to live in Nevada though, because they've got mansions there too that they visit once in a while, enough days to stay out of California. And then they come to Silicon Valley and they hang out at the Rosewood. And one of them talked me into getting licensed in Nevada. He said, there's so many guys like me in Nevada, you should be licensed in Nevada. So I got licensed in Nevada. I took the bar exam. You know what it's like for an old guy like me to take a bar exam? It was my 6th one, maybe 7th. See, I can't even remember anymore. And then nothing happened. Nothing happened. 20 years ago, a lot of companies incorporated in Nevada. 10 years ago, a lot of companies incorporated in Nevada, and I thought everybody would because all the money was moving there, but it hasn't happened. It's Delaware. 99% of the companies I form are in Delaware. I'm licensed in Nevada. I'm not licensed in Delaware. I form Delaware companies. It is just the gold standard. It is internationally recognized. If you're not in Delaware now and you take VC money, they're going to force you to move to Delaware, to migrate there. And by the way, if you're a California corporation, as usual, everything's more difficult. You have to actually merge into a new Delaware corporation. It's not as easy as if you're a Nevada corporation. When would a Delaware C Corp need to register in California? Good question. So we form your company under Delaware law, but then your office is here. Your office is here in California. I was going to say your office is in San Francisco, but I know what a cruel joke that would be to say, so I'm not going to. I could see some of you would probably start crying if I reminded you of those good old days when people wanted to live in San Francisco. But you're still going to be here in California. Probably be down here in Menlo Park in my neighborhood, right, where you can park a car. So now what? Do you have to get into the California system? Yes, you do. You have to register at the Secretary of State's office. They want to know you're here. They want you to have a resident agent for service in case someone wants to sue you. Most importantly, they want tax revenue. They want $800 a year minimum taxes plus an allocation of income. By the way, new law, we've got so many new laws this year in California. You would be amazed at what our legislature has been up to. I'm not kidding. You'll be amazed when you start seeing this stuff. But here's one. Here's another new one. Every company doing business here now, when you file your annual statement of information, you're going to have to tell the state that you haven't skipped out on paying payroll taxes on your last company. Okay, apparently that's a big problem. People form companies, they don't pay their payroll taxes, and they shut it down. They form a new company, and they just keep doing that, not paying payroll taxes. Now you got to promise that you're not one of those bad guys, one of those tax avoiders. There's a lot of stuff like that in California. So your question now is, there's no customer here, but the founder's here. That's enough. That's enough. Your founder's an officer's an employee. That constitutes an office. You need to qualify here. You're not going to get that advice from everybody, by the way. You're only going to get that advice from people like me who've been in California since 1990 and have fought with the Franchise Tax Board over and over again and again, over and over this issue. You just qualify. Close cases, just qualify, pay your $800 and you can sleep at night. All right, boy, you really got me going on that one. What if you don't create your C Corp until you're a year into your part-time working on a company? When does your 3-year vesting period start? Good question. Your 3-year vesting period starts whenever you want it to start. It's all a matter of contract. But that is not your biggest problem, right? If you haven't started your company until, formed your corporation until a year into it, vesting is not your biggest problem. You know what it's like? It's like that commercial where the woman is showing you the laundry detergent that can get blood stains out of your shirt really well. If you got blood stains in your shirt, I don't know, your brand of detergent is probably not your biggest problem. Same here. You waited too long to start your company. At that point, you probably got lots of people claiming to have ownership of your IP. You probably got other people claiming to have ownership of your company. Form a company, form it early, get your IP ownership settled. We're going to talk more about this in 2 weeks. Get your equity ownership settled, get your vesting agreements in place. If you wait too long, everybody's memory is going to change and the deals. Now I know if you're a solo founder, you've got a little bit more leeway. All right, you got a little bit more leeway, but you're still exposing yourself to infringement claims for that year. You could have personal liability. So I'm a big fan in keeping the blood off the shirt and starting a company early. Yikes, here's a tough one. Founders, co-founders, advisors, strategy advisors, what percentage should they have on the cap table? To answer that question, you're going to have to tune in 2 weeks. It's in my slides, or you can just get my slides, and we're going to talk about that. I do have some rules of thumb, believe it or not. There are rules of thumb out there on the internet. There are a couple of sites that gather data. There's actually tons of data on this. Founders, co-founders, we just talked about. There's 4 ways of splitting that equity up. It's more art than science, but I can give you some scientific and mathematical models that'll help you get close to the right answer. The important thing is not so much you get the exact right number. The important thing is that you all think it's the fair number. Because if you don't, somebody's not going to work as hard for this company as they want, and some investor is not going to invest in you because they think that your incentives all misaligned. So people have to, it's more perception than reality. I guess perception is reality. Advisors, 0.25% on up, depends on who the advisor is, okay, and how much effort they're willing to put in. I see a lot of advisors at 1% on cap tables these days. That percentage, by the way, I've noticed has been drifting upward over the years. The reason it's been drifting up, okay, let me vent again. I think the accelerators and incubators have created some equity inflation because it seems to me accelerators have been taking more and more equity in the companies for their service. I'm not saying they don't deserve it. I'm just saying I've been noticing that. And I've also noticed advisors have been taking a little bit more and more equity as they go along. But use the FAST table and you can come up with a number. By the way, the FAST table, you figure out what stage you're at, how involved your advisor is going to be, and you just kind of find where they are on the grid and you know how, you know, where the company is, how involved the advisor is, and that's where you are on the grid. And who else? And then strategy advisors. Yeah, the people who are really tough to figure out are the people who you don't know what their contribution is going to be. That's why you got to have vesting. That's why you got to have milestones and performance metrics. It takes a lot of the guesswork out of this. What do angels look for? Holy cow. Okay, what do angels look for? Ask Jason. He'll tell you all about it. I think what you mean is what percent do they look for. So when you have an angel come into your company, even though they want equity, you're not going to give them equity. It's way too early. It's too soon. You can't value the company. And if you try to, you're going to give them too much of your company, right? Instead, you're going to give them a convertible instrument, either a convertible note or a SAFE. They call it a SAFE, simple agreement for future equity. What this means, it's like, this is Popeye and Wimpy. You know, I'll gladly repay you on Tuesday if you will buy me a hamburger today, right? They give you the money today, you give them a hamburger later. You give them the stock later when you finally do a financing. That's a SAFE. In fact, I'm going to create my own SAFE. I'm going to call it the Wimpy because that's what it is. Nobody on this call other than me is old enough to even know what I'm talking about. But trust me, that's what it is. You take the money now, you deliver later. So you're not going to give equity away. You're not. You might have a valuation cap. In fact, you likely will. So there'll be a minimum amount of equity they're going to get for their money. And that's where you guys get in trouble. We're going to talk about that in 2 weeks. Don't make that mistake. I've seen more than one company start just handing out safes like they're sticks of gum. They're selling their safes and their convertible notes because it's not equity. It just converts into something in the future. And, you know, I'm the grasshopper, not the ant. I don't care about the future. Then the future comes, you get to your financing and you figure out how much of your company you've given away in safes. And it might tank your financing because the investor says, wait a minute, there's not enough equity here left to incentivize a founding team. You know, next. Okay. Yeah, I'm going to have to punt on this next one. Should you focus on multiple markets or a single beachhead market? I don't know. That's beyond my pay grade. I think you're going to have to. That's why you get VCs, right? That's the kind of good advice they can give you. That's why you get people with domain expertise. That's why you get people that understand markets a lot more than I do. I'm just a lawyer. Can you skip a seed round and jump straight to round A? Sorry about my voice. We must have smoke here again today. Yes, you absolutely can. Companies do that all the time. We do that frequently. And to do that, however, you have to have the right metrics. So you will do that. You will qualify. You will join that rarefied group if you're a successful serial entrepreneur. If you've gone to the VCs and if you've made them a ton of money before, then yes, you can go back to them after you've put in a little bit of your own founder money and launched. And you can go back to them, and you actually can go right to Series A. You can do that. Not everyone can do that, and you don't want to, okay? Let me tell you something. You probably don't want to. We're going to talk about this in 2 weeks, but you want to stage your financings. You want to take as little money as possible at low valuations, right? Because the more money you take now at your low valuation, the less money you're going to take later at a high valuation, and that means you're going to give too much of your company away, okay? So you want to take early money, and you want to take it at a relatively high valuation cap, okay? We'll talk more about that. I know I didn't explain that well because I want you to come back in 2 weeks. What happens to angel investors when the VC comes in? Did they get paid out and the VC takes their holding? No, that's not how it works. Oh, no. You're so young, grasshopper. What happens is the angels, they stay there till the bitter end. They hang in there. If they got a convertible, they convert into the same security or a shadow security of what the venture capitalist has gotten. Or if they had an equity security, they'll just hang on to it. But they stay until an exit. They don't get cashed out. Nobody gets cashed out. Sometimes some founders can take some money off the table, right? But you can't fool all of the people all of the time. But sometimes you can have a founder take some of that VC money and redeem some of their shares. Almost never at round A, sometimes at round B. We'll talk about that next week. God, I got a lot of stuff to talk about next week. We might have to have a part 3. All right. Somebody has a really long question here. Oh, geez. You sure we want me to read this? Okay. The question is, somebody got involved in a deal a long time, and they had a falling out with their co-founder who turned out to be an ex-boyfriend. And it's popping up all over Google. So let's talk about this. There's a couple of things. Number one, I have had companies, many companies in the, 80 or so years I've been doing this, that have been boyfriend, girlfriend, or boyfriend, boyfriend, or girlfriend, girlfriend, something like that, where the two founders were personally involved. I've had that happen. That has never once in my entire life worked out. I've never seen that work out well. Never once. Not saying it can't. No hate mail. I'm not the devil. I'm not trashing relationships. I'm just saying I've never seen it work out well. It's just it's too close. It's too much. Something goes wrong. People disagree. So I would avoid that scenario if you can, because although I know your deal is going to work out fine, I know your relationship is strong enough, you guys are solid. I mean, I'm not concerned about you. I know that you're going to be just fine, but I just think it'd be best, and the one in a billion chance that something goes wrong. I think it'd be best that you not go into business with your significant other. Okay, that's my advice to you. Second point, what's the investor going to say about this? Well, it kind of depends on the lawsuit, okay? It kind of depends on the lawsuit, and it depends on the company, and it depends on the investor. I hate to say that, but it is absolutely true. First of all, be very upfront about this. The VC is going to do a background check on you. If they come up, they find felonies, you want to make sure you tell them about it. They don't find it because they're going to think you're holding, plus you got a securities law issue. You need to disclose that anyway. If it's a felony that involves dishonesty, that's pretty bad. That's pretty bad. You might want to stay off that cap table. If it's a felony that involves, there's a guy here in Silicon Valley that he got charged and convicted of a felony for kicking a dog. Now, I'm not in favor of dog kicking. So again, stop with the hate mail, stop the letters. I'm not saying you should kick dogs. I'm just saying it doesn't really reflect on his ability to be a good founder. And that company went and got financed anyway. So it kind of depends on what the problem is. If it comes down to lawsuits, that's as opposed to criminal matters, that's a little different. It kind of depends on the lawsuit as well. If it involves fraud or dishonesty, that is really bad. That's awfully hard to get over. Anything else, you might be able to explain it. And part of this is political, by the way. If it's kind of the flavor of the day, bad policy thing that you shouldn't be doing, if you're a litter bug, now when we're all concerned about the environment, your impact sustainability investor might not want to be associated with you. So it depends on the investor, depends on the company, depends on you. What is generally the shareholding? You got 5 minutes left. I am not going to get anywhere near through all these questions, but I'll tell you what, email me and I'll do my best to get back to you. Failing that, tune in 2 weeks. We'll try to do it again. Okay, next question. What is generally the shareholding you give to angels before the venture capitalists come in? I hate to keep punting, but we're going to talk about this next week. I promise. I swear to God. But generally, the angels, they're not taking any shareholding. They're taking convertibles. The convertibles are going to convert into shareholding. I'm glad you're thinking about this, Mr. Anonymous attendee. You're my favorite attendee, by the way. Not to diss the rest of you, but that's a good question because you need to be thinking ahead as to what their safe or what their convertible is going to convert into, because you're not thinking you're giving them shareholdings because you're not, but you're giving them a wimpy, right? And that wimpy is going to convert into a cheeseburger down the road. You want to know, get your Excel spreadsheet out and figure out how many cheeseburgers they're going to have on Tuesday when you have to repay them. So what generally should you give them? Do your math, figure it out, figure out that you're going to give 20 to 40% to the VCs and Series A and all the other investors and all the safes. So you got 40% to all the safes and investors. You got 20% in the option pool. What's that going to leave for you, right? You better have 50%, 40%, for your founding team after Series A. We're going to go through some real examples with real cap tables next week, but I'm glad you're thinking about backing into these numbers because you totally should. All right, somebody asked for information. Actually, I'm going to give you my email address. Typing it. I've misspelled my name. Not with a C though. I would never make that mistake. All right, is it acceptable to be an LLC when trying to get funded, or is it a red flag? It is perfectly acceptable, provided you understand you're going to have to convert to a corporation when the VC closes. We do that all the time. We start as an LLC. I wish we had more than 2 minutes left. I would give you my whole lecture on why we do it that way, but sometimes you start as an LLC and with the understanding, if you're smart, you've hardwired into your documents what's going to happen to all the stakeholders when you do convert. I feel terrible doing this to you, but I'm going to do this to you anyway. I'm going to leave you with something. It's really hard to do a safe or a convertible note, and I shouldn't say really hard. You can do safes and convertible notes in LLCs. I'm going to say that again. An LLC can issue safes, an LLC can issue convertible notes, but they're complicated. They're complicated. Stock options in an LLC are complicated. Equity comp is complicated. All of that stuff is complicated, but it can be done, right? You just need to be smart about it. You need to think through the issues. You need to have it set up the right way. All righty. Let's see. I only got time for one more question. One more. Who's it going to be? Who's the lucky person that gets one more question here? I'm going to take this one. Is there a way to form a C Corp before having a final name for the company? Well, you could be super original and call it Nuco, but I've heard that name is taken like about 1,000 times. Look, you can change a company name so easy. Just use your address. Call it 149 Commonwealth. it's too late. I already took that one. But yeah, just use any old name. You can change it super easy. That's the name, not your brand, not your logo. That's a whole nother discussion. But yeah, you can form your C Corp before you have your final name and then change your final name. In fact, the VCs may make you change the name. They often do that because they hate your name. And of course, they know better than you. That's why they're the VC and you're not. So they'll give you a name. So you may end up changing it anyway. Okay, with that, I am going to thank you, audience, for being here, for all those awesome questions. That was cool. And now I'm going to turn it back to you, Rob.
That was a lot of good information, and it was very entertaining as well. Roger, thanks for spending time with us and sharing your expertise. Audience members, thanks for tuning in, and thanks for asking great questions. See you next time.